with a very strong underlying business mode. They have a very strong balance sheet, they have very strong ROE, they have very strong return on capital employed, they have very strong free cash flow. But above all financial, very important is they have very strong management with the right corporate governance.
Tough situations need tough solutions, and this is the underlying philosophy of ALFaccurate Advisors, one of the leading PMSs in the industry, which has almost 10 years of track record. And today we have amongst us Mr. Rajesh Kothari, who is the founder and managing director of this PMS. Welcome, Mr. Kothari. First of all, many congratulations for completing 10 years. Today we would like to understand from you what are the secrets of stock picking that you follow, and the tagline of your PMS says protect capital and create wealth. So I would first like to understand from you, your focus on protect capital. What are the underlying pillars that you have built on your stock picking strategy, where you claim very confidently to all the equity investors that by selecting ALFaccurate PMS, one can expect equal importance given to protect capital as maybe creating wealth.
So thanks, Kamal. First of all, congratulations to you as well. I think you have started a beautiful journey of PMS-AIF.com, and I think it is a what I would say long requirement of PMS industry to have such firm who also do a lot of work on entire PMS industry in general. Coming back to your question, you are absolutely right. So let me give an example. So if I give you an option that Kamal, you want to travel from Bombay to Pune, there are two options available to you. One is, of course, old Bombay-Pune, and second is Bombay-Pune Express Highway, am I right? Maximum number of accident happens on Express Highway, but that's the smartest and probably the best option to reach fast, am I right, if you want to visit Pune. So what you need to make sure that, yes, that is the best option, despite maximum number of accidents happens there, but you need to put your seat belts on when you are driving Bombay-Pune Express Highway. You need to drive a car in a good condition, and of course, you need to have a good driving skills. Equity market is something similar. In equity market, in long term, it will keep giving the better, superior returns compared to any other asset class, whether it is a fixed income, whether it is a real estate, whether it is a gold. Not only in India, if you look at globally, last 30 years, 60 years, 80 years of US Dow Jones market, which is a much developed market. Even today, the US equity market has outperformed all other asset classes even in last 10 years, despite the volatility, despite the global financial crisis. So equity market will keep creating superior returns, but in equity market, in same market, as I said, the volatility is going to be very high. The world is moving towards VUCA world, which is a terminology called volatility, uncertainty, ambiguity, correct, and complexity. So in this VUCA world, the world is becoming more volatile, business cycles are becoming shorter, business cycles are becoming faster, and therefore it is very, very important to focus on risk management, which is a hallmark of a AAA investment strategy, that is that how we can reduce the risk and still keep creating wealth. So that's basically what we what we try to do.
Sure. So your strength, in terms of managing the portfolio is to protect capital that you have covered. But I am, subsequent to that, I am wanting to understand from you that what are the,
how we do that.
Correct. How you do that? Absolutely.
Perfect. So basically, we strongly believe, Kamal, that when you buy any company, you are buying into somebody's business. Correct. And when you are buying into somebody's business, there are three important risks which you are taking. The first and foremost risk is corporate governance risk. Second important risk is technology risk. And third important risk is business cycle risk. And of course, the business cycles, if you look at Dow Jones in 30 years, probably there is not a single company in Dow Jones today which was there 30 years back. Correct? If you look at Sensex in 16 years, 75% of Sensex companies have changed in 16 years. So all those companies, they were great companies. For example, say MTNL, say for example Bail, they all are blue chip companies. But today there are no more blue chip companies because business cycles, probably they could not manage the business cycles, and therefore they not only went out of Sensex, But many of those companies which exited from Sensex are also went down 60, 70, 80, and some companies are down 90%, 90% from their peaks in their lifetime. So that is a very important thing, that's the reason that if you want to mitigate these three risks, corporate governance risk, technology risk, and business cycle risk, only way to mitigate this risk is to diversify. There is no other option. Because irrespective of how much research you do, irrespective of how many times you do plant visits, management visits, due diligence, so on and so forth, there are many unpredictable variables. And it is because of that, if you want to reduce the impact of such variables, like for example, US FD import alert, like for example, oil spill, or for example, like Boeing, recent crash, correct? Stock price went down significantly after that accident. Can you predict it? Answer is no, irrespective of your knowledge on the segment or business or in the management. So what we do is that we diversify across 40-50 companies, we diversify across 13 to 17 sectors, we diversify across large cap, mid cap, small cap. And because of that diversification, even if there is a damage, because even we can go wrong, I mean, you can't predict accident, for example, Boeing, or you can't predict oil spill. So even if there is a damage, the damage is very, very limited, correct? And that's something very, very important. Protection of capital is very important. So that's a one way to reduce risk when you are buying equity. Second important thing is staggered investment approach. So we do not have model portfolio, and we buy over a period of time, we do staggered approach. And last but not least, and something which I always believe is very important in equity market, is focusing not only what to buy, but equally focusing on when to sell. Exit is as important as entry. And we were very, very, I would say, strict exit strategies, which further helps to reduce the downside. So this is how we try to do the risk management.
Right. So, in general, the understanding is that, one has to take higher risk to get higher return. But seeing the performance of ALFaccurate PMS, though, as you are claiming that it is a very well diversified portfolio of more than 40 companies, and there are emphasis given on a lot of risk related factors while stock is selected, but in spite of so much focus on diversification and risk, the return given by the strategy over the last 10 years is 18 to 20%. So how do you guys manage to deliver such high return with so broad based diversification?
Correct. So of course it's a very interesting question, and you are trying to get into secrets of how we create wealth for our investors. So what we do is that we have for stock identification, we have a 3M investment approach, which is called market size, market share, and margin of safety.
Okay.
Market size is size of opportunity. So we buy the company provided sector in which company is operating is pretty large, so that if the promoters are good, you have a natural economies of scale, and that result into stock giving multi-bagger returns. Second one is market share. So we buy the companies provided they are market leaders in their own segments, because we strongly believe that any business, any industry can go through up and down turns. And if you buy a leader, then ability of leader to absorb any downturns is very, very high. So in upturn, they not only gain market share, but actually in downturn also, because of their underlying leadership character, generally they gain market share. So they gain market share in both parts of the cycle, in both downturn as well as upturn. Actually in downturn, they further gain more market share because it's very, very difficult for marginal players to remain in the field in the downturn. Correct? And what is stock market returns? What is stock price returns? It's nothing but mirror of earnings growth. So if you buy the companies who have a lesser volatility of earnings compared to their own peer group of their respective sectors, and also superior earnings, that means superior earnings growth with better return on net worth and better return on capital employed, again compared to their own peer group, by default, the stock price returns are also less volatile and more superior over a period of time. So I'm not talking about a 1 day, 2 day, 3 days, I'm talking about over a period of 1, 3, 5, 7, 10 years. So your earnings are less volatile and earnings are more superior, and therefore market cap returns are also less volatile and more superior. And third is nothing but margin of safety, is nothing but valuations. So it is a combination of that approach which results into what I would say right stock identification, making sure that you buy the companies which are really very, very solid, with a very strong underlying business mode. They have a very strong balance sheet, they have very strong ROE, they have very strong return on capital employed, they have very strong free cash flow. But above all financial, very important is they have very strong management with the right corporate governance. Right? And generally speaking, if you look at globally, in many segments, the leaders generally have superior financials in the long term. In the short term, generally, they suppose, if a company is entering a particular segment, on day one, you may not have 20% return on capital employed. But as a company as a whole, if you look at it, whether you look at Unilever, whether you look at Nestle's, or whether you look at any global company, which a very strong underlying market share, typically they also would have underlying very strong free cash flow. And it is underlying that strong free cash flow which gives ability to the company to reinvest into the business. And whatever their competitive mode is, if it is distribution network, if it is branding, if it is a best of the plant, if it is best of technology, whatever the mode you are enjoying, you will keep sharpening it further, and which will further help you to not only make sure that you keep getting earnings growth, but it also helps you to keep competitors away. Say for example, 3M Global, so they spend annually huge R&D budget, which they write it off in their, through the profit and loss account. So there are a handful of such companies, which of course has a very, very strong such product portfolio and such strong market share in players like 3M. But otherwise, so this is the trend. This is how we try to identify the companies with a strong balance sheet, as I mentioned, and strong management, and underlying strong free cash flow, and that helps to generate.
So exit strategy, is something which I also realize that matters. There are a lot of funds I have seen, which show virtual returns over years, but when right exit calls are missed, then all those returns are ultimately not delivered, and then one has to wait and it becomes long term buy and hold. But when you're talking about exit strategy, I think it's part of your risk philosophy.
Absolutely.
So I'm curious to know more about your exit philosophy. What are the cues that you would kind of see, analyze, and then take call on exiting a stock?
So one important part of exit strategy is the valuations, of course, because ultimately you pay that valuation for that high earnings growth. But if the earnings growth comes down from 60% compounding to 40% compounding to 30% compounding to 18% compounding, then that high PE of 70, 80 times are not sustainable. And it will gradually come down to 30, 40 or maybe even 25 PE as earnings growth tapers down. So one is valuation and second is earnings growth. These two things, it is a combination approach which is very difficult. So what is important therefore is the business cycle. You need to make sure that the companies which you are holding, they have a reasonably good what I would say business cycle opportunity, so that if there is a growth which we expect our being the leaders in their own segment, they are expected to do better than the aggregate industry. And industry is a function of say GDP, it is a multiplier of GDP. So say for example, if GDP is growing at say 11% and let's assume industry is say 1.2 times or something like that, then the company which we are holding, they should grow at 17, 18, 19%. And that's something very, very important. But if the industry growth itself is going to be slow, then the while company will keep doing better than industry, but it will fall short of our expectations of 18-20% earnings growth. Correct? So earnings growth, the business cycle is very important. The mode which company has created, because it is very easy to get carried away by the modes of the company. But the world is becoming complex, it is becoming dynamic, and disruption is a buzzword. You need to make sure that company is able to retain that mode. And those are very, very critical things to monitor upon. And if at any given point in time, if you believe that a company may not continue to probably gain market share, or company may probably face lower ROE the growth is higher, but at the cost of incremental ROE. Those are basically the red flags which you need to monitor upon, and that's where you need to exit or reduce. And of course, we also have a profit booking strategy. So even though we may buy, say for example, 3% of a particular company, and if the stock doubles, then we do not hold to that level, and we again make it to the because of rebalancing strategy, we again make it from say 6% to say again 3%.
Right. So today we see a lot of new fund managers leaving leaving mutual fund industry, starting on their own PMSs. A lot of youngsters, a lot of research analysts, they wanting to start their own PMSs, because the culture of equity investing is kind of gradually going up. But in 2009, all these things were kind of not that visible, but you were able to view them.
Right.
So
yeah. So basically, having worked with the industry for so long, I'm into market probably since about 1994, so about 27 years into market. One thing was very clear to me, that if I look at US market, the number of funds there, which is just not only mutual funds kind of thing, but also number of hedge funds over there, it's huge. The number of family offices is huge, and it required a customized approach. You cannot have one fit for all solutions. You require a customized approach. Large families particularly, they have different requirements. They probably may not want the same standard product what industry was offering at that point of time. So clearly I could see that there is going to be customization at some point of time, and the demand of that is going to go up significantly. Of course, on the other hand, I could also see that the number of families who are coming to that bracket of ultra high net worth and high net worth, from middle to HNI and HNI to ultra HNI, surely that was expanding, and there are only a handful of players who were willing to give the right solutions. So I could see that the gaps are huge, and in our industry, what is most important is probably not performance. What is most important is pedigree. Pedigree of people with whom you are putting your money, and integrity and trust. Because at the end of the day, we are trustees of somebody's money. We are just doing on their behalf.